So we would have seen that when we are talking about getting our finances in order, we're going to look first at seeing what we want to accomplish. We're going to see where we are. And as we start to plan getting from one spot to the other, we saw that we want to spend less than we are earning. We want to plan for the expected with things like our irregular and variable expenses. And we want to prepare for the unexpected, which is the emergency fund. And again, we have a very good example with COVID just it's hard to believe it was just about 2 or 3 years ago, where so many people did not have, like I said, we were blessed in South Korea, but that people did not lose jobs and people did not lose salary. But there were so many people who lost jobs and had a cut in salary that they would have been so glad to have had an emergency fund to fall back on in the event. Now, we know we're living at the end of time, so we expect anything could happen again at any time, right? So we want to make sure and have our emergency fund. Now, one of the ways we could start to have increased surplus so that we could now work towards meeting our goals is by reducing and getting out of debt. Because when we do that, remember now your net worth situation, we reduce the amount of liabilities and we increase our net worth. So if we look back at the National Financial Literacy Survey, we saw that 27% of the respondents said they had too much debt. And remember, 51% said they had to borrow to cover expenses, which means there's a lot of borrowing going on. There's a lot of debt out there. Now, the Bible tells us a lot about debt. And it even gives us some guidelines on managing debt. For example, it tells us not to take on long-term debt and don't co-sign loans and have to repay what you owe. But the thing is, Proverbs tells us that the rich rules over the poor and the borrower is servant to the lender. So we should really avoid the bondage associated with debt, and it is bondage. I always remember my parents way back when they had a mortgage, and I remember there was a period in time. It felt to me like every other month, but I think it was over a period of 2 years. They might have gotten about 3 or 4 letters from the financial institution just saying, the rate has gone up, this is your new payment. And they can't do anything about it if they want to keep the home, right? So you really are a servant, you have to do what the lender says. So should we go into debt? Now, debt is not forbidden in the Bible, but it is certainly discouraged. Because remember that debt causes a significant amount of God's resources to be lost through the payment of interest and loans. That is just money down the drain. And if we were to look at the average mortgage, for example, you would find that at the end of the mortgage, you would have paid about 3 times the value of the home. That's a lot of money, especially when homes are already so expensive. So how do we manage all of this? We are counseled that you must see that we should not manage our affairs in a way that will incur debt. And when you become involved in debt, you are in one of Satan's nets, which he sets for souls. Now, we recognize that there are some things that, a mortgage, for example, the average person will not be able to save for a mortgage, right? We recognize that. So the key thing is here that where we could avoid it, we avoid it, and where we have to use it, we use it wisely, right? So we are told, make a solemn covenant with God that by his blessing you will pay your debts and then owe no man anything if you will live on porridge and bread. Deny self at least while you are walling with debts. Deny your taste, deny the indulgence of appetite. Save your pence and pay your debts. Work them off as fast as possible. And I have found that even in the Seventh-day Adventist Church, there are a lot of people who are really floundering under the stress of debt, right? So, and that's one of the areas that I really like to help people with getting out of debt. That's an area, when cases look impossible, I know God has a way of sending wisdom to get it. I worked as an associate consultant with a financial planning firm. And in it, we would usually be hired to do counseling sessions when companies are either retrenching people, or sending them fees up. So we would go and help them in terms of how to manage their lump sums and how to invest. And I could tell you, having counseled a lot of people on managing their money, There's just one case I could remember that we couldn't find I couldn't find the solution for. Honestly, I prayed so much. But that was somebody I think God wanted to make a point for that person. You know, the fact is, with God's blessing, we could do it if we set our mind. And always remember, it's not forever. It's a period until you get out of debt, for example. So, how do we go about managing debt? There are 4 main categories. I'm only going to cover 2 of them. If we have time at the end and you want me, I'll cover the other 2. But we talk about car loans, hire purchase, mortgages, and credit card. The 2 main ones that people have challenges with would be the credit card, because of the extremely high interest rates, and of course the mortgage, because it's probably the largest loan anybody would take. So let's look at the credit cards first. Now, credit cards offer easy access to credit. But the interest rates, as I said, tend to be some of the highest in the market. Now, if you pay your bill in full on or before the due date, you are not charged any interest. If the balance is not paid in full, then 2 things must happen, or 2 things happen. Firstly, you must make at least the minimum monthly payment not to get hit with extra charges. And then, this is what a lot of people don't know. Interest charges are applied based on the full purchase amount. So for example, you used your credit card and you ran up a bill of $1,000 and you pay off $990 and you say you're only carrying forward $10 to the next month. Most people assume that you pay interest on the $10, right? Nope. You pay interest on the entire $1,000. That is not something the bank's going to tell you. All right? And I had a case. This one was a case of a senior lady. She would use her credit card and then go on the phone and pay it off every month that she got her statement. And she was asking me, she said she can't understand. She pays off her card every month, but yet every month when the statement comes, she's seeing much higher charges than she knows she used the card for. She would keep her receipts. And she's saying, you know what? So she was showing me the receipts that she had, and how come they're charging us so much more? And it's only when I started to go back. There was 1 month, it had been 8 months before, that she got her statement late. So when she paid it, it was paid late. By paying it late, even though she paid off the entire amount, she got charged interest. The interest was added to the next month, but she knows she's paying off her full card every month. She only paid off the amount that she knew she spent in the month. But there's a trailing balance now. So she is paying the interest on everything month after month after month and couldn't understand. And she lost a lot of money until we were able to find out it was just by that one statement being late. So I had to encourage her and tell her, listen, in the future, don't wait for the statement. You know what purchases you made, keep them in a little book, and on this date, make your payment. Statement or no statement, you know how much you have spent, right? So, you always try to pay your entire credit card bill in full each month. And you could always try also to maximize your interest-free period. And to do that, you need to know your dates. What dates am I talking about? Well, there are 2 main dates you need to know with the credit card. By the way, how many people here have unused credit cards? Okay, enough for me to continue, right? The first date you need to be aware of is your bill date, which is also called your statement date. Now, that is the date on which the bank runs it runs your statement. And what would happen is that all charges to your credit card up to and including that date would appear on the statement. And those amount of charges would now become payable on your due date, right? So the statement date would be the date they run the statement, and charges would be included, all outstanding charges up until that day would be included on the statement, and you have to pay it off by the due date. So let's see. If, for example, your bill date is the 15th of a month and your due date is the 30th. And let me just say this. Different credit cards have different due dates and statement dates. Different banks have different statement dates and even within a bank, like I said, different cards. So you need to check it. When you go home, look at a statement, either online or a physical statement, and look for bill date or statement date, look for due date. Those are the 2 dates you want to know. Okay, so back to the interest-free period. So think about this, and a question I'm going to ask you now. So your bill date or your statement date is the date your statement is run, and it includes all charges up to and including that day. The due date is when you have to pay it by, as to not incur any charges. What, therefore, in this example, if your bill date or your statement date is the 15th of the month and your due date is the 30th of the month, what is your maximum interest-free period for this card? Anybody wants to try and take a guess? What is the maximum period you get being interest-free? Tell me in terms of month 1 and month 2. Nobody brave enough to try? Okay, I'm hearing somebody. Just stand so I can recognize you, Annie. Tell me you're not seeing it clearly? Okay, so when you have month 1, on the 15th is statement date, 30th is due date. Month 2, same thing, 15th is statement date, 30th is due date. That's what is written there. Okay, so what's the period? Tell me from when to when would be your maximum interest-free period? 16th of when? 16th of month 1 until when? 29th of when? Month 1. And okay, so somebody is saying the maximum interest-free period in this case is 16th of month 1 to 29th of month 1. How many agree? Okay, you have some support there. Anybody has another interest-free period? All right, just because of time. If it is the 16th, right? Okay, so let's take what she said. It's from the 16th, and that is correct. The start date is correct from the 16th. Because if you have a purchase on the 16th, when is that going to appear on a statement? Right, it's going to appear on the statement, which is on the 15th of month 2, right? Now, if it appears on the statement of month 2, when is it due? When will it be due? The 30th of when? Month 2, correct. So the maximum interest-free period in this case would be from the 16th of month 1 to the 30th of month 2, right? Because when you make the charge on the 16th, it shows up on a statement on the 15th of the next month, and if it shows up on that statement, it's payable on the 30th of that month. Yeah? Everybody's okay with that? You're sure, right? Okay, so since you're okay, I'm going to take a little quiz now. So tell me then, what is the interest-free period for a purchase made on the 24th of month 1, assuming no other charges and the bill is paid in full when due? What is the interest-free period? You make a purchase on the 24th of month 1. So again, work it through. A purchase on the 24th of month 1 shows up when? On the statement on the 15th of month 2. And when is that payable by? 30th of month 2. Very good, right? And if it is, okay, just now. Right. And if you make a purchase on the 14th of month 1, what is your interest-free period? Again, work it through. You purchase on the 14th. When is it going to show on a statement? 15th of which month? Month 1. So when is that payable? 30th of month 1. Very good. So we could use these little things just, sometimes the banks take advantage of us. It's a good thing sometimes to take a little advantage of them. So, if we want to make our purchase. Now, very important, you're only using your credit card for something that is in your spending plan. Because in your spending plan, you would have money available to pay it off. Right? So you could very well use, time things where you make your purchases the day after the statement date, right? And enjoy the bank's money for as long as. keep your money in your account until you're ready to pay it off, all right? But make sure, very important, make sure you have money in the account to pay off when it is due. Is that clear? All right. Okay, so the other one we're going to look at is the reduced and balanced loans, which are like credit union loans and mortgages. We wouldn't look at credit union, we look at mortgages. Now, mortgages are probably the largest loans most people make in their lifetimes. When we talk about amortization or amortization schedule, it's the period over which the mortgage is going to be repaid. And we'll talk about the interest and the principal. The rule of thumb is that the longer the amortization period, or the longer the period over which you take to pay off the mortgage, the lower will be your monthly payment because you have a longer time to pay it off, but also would be the higher the total amount of interest paid because you're now keeping the bank's money for a very long time, right? So the counsel we were given before was, remember the counsel with regard to the length of time? What's the counsel? Keep it as short as possible, all right. So this is a sample schedule here for a mortgage of $150,000. Yes, I know there is no place available for $150,000, but folks, trying to put $1.5 million into this little table, it is just too squingy, okay? So I am going with $150,000. So this is for a mortgage at 7.5% fixed interest over 30 years. The payment is actually 1048.82. I'm just rounding it off when I'm speaking to 1,050. So how it works, you have a fixed amount being paid back. As you make the payment, so you would see in the column of payment, you've seen that fixed. Now I know it's not very clear, but I hope it's clear enough for you to follow me. Okay. So the payment is fixed. So you're paying back every month the fixed amount of $1,050. And when you make that payment to the bank or to the whichever institution you borrow from, part would go towards paying the principal and part would go towards paying the interest. Because it's a reducing balance loan, you would see that the interest that is being charged changes, and it changes based on what the outstanding balance is. Okay? So when you find that as the mortgage starts, your principal payments are very, very small because you have the whole mortgage outstanding to pay, which means the interest rate will be very high. But as you continue making payments to this mortgage and you continue paying down, the balance outstanding decreases, so therefore the interest charge decreases. With me? Okay. So let's look at this. So we're paying $1,050 every month, split between interest and principal. What if, instead of sending $1,050 for that first payment, I choose instead to send $1,300? So in other words, I am sending $250 more than the mortgage payment. What happens? Well, firstly, the bank would take out the $1,050. Remember, I'm wrong, did it right? They take out their money, which goes towards part interest and part principal. And then, of course, they have $250 extra. Once you specify that it is towards principal, and there are some conditions I'll tell you at the end of this illustration. Once you say it's towards principal, it means it's to go towards the principal. They have gotten their money. So the extra now goes towards principal, right? Which would be, I'm just rounding, for the equivalent of payment 2 and 3. So what would have happened is that your next due payment would be payment 4, because what is now the outstanding balance? Remember, it's a reducing balance mortgage. So your outstanding balance now is, if you could see it clearly, $149,663, right? So when you send your payment the next month, that's all the bank is looking at. What is now the outstanding balance to determine how much is taken out as interest and how much remains for the principal payment. You all with me with this, right? Anybody needs me to say it over? Okay. So it means that by spending that $250 extra, what you have done is you have reduced your mortgage period by 2 months. And you would have saved interest payments of $1,873. all right? So when the next month comes around, of course, now payment 4 is now the payment that's due. So if you send another $250 extra with your payment, the same thing happens. The bank takes out their own and then applies the extra to the principal. So in essence, you would have reduced your mortgage by another 2 months and saved an additional $1,869 in interest payments. So you would, by paying $500 extra towards your mortgage, you would have reduced your mortgage by 4 months and you would have saved $3,742. Now, isn't that an excellent investment? Ain't nothing giving you returns like this, right? But of course, there are always conditions and caveats, right? The first thing is that a lot of the banks first of all, they're not telling you this, right? Second of all, they don't like you to do this because that is just $3,700 that they would have lost. So what they tend to do is they tend to give you a whole lot of conditions. For example, I've seen different things like you're only allowed to do that extra payment once for the year, and if you're making the extra payment, you have to pay at least a whole year's mortgage amount. All sorts of conditions. You have to give 3 months notice before you could do that. All types of things. When you are looking to get a mortgage, if you choose to go with a bank, you negotiate. You see, many times we tend to feel like the bank's doing us a favor. They're not doing us no favor. They need our money to make their millions in profits. If they don't have our money, they ain't getting money for the shareholders. We can negotiate. Let them know, listen, this other place is offering me this. So, let me just cut myself to this. I remember, some of you may have known I had a store in Port of Spain at one time. When I was going to open that store, I had the cash for it. But I went to my bank and I said, listen, I have the cash for it, but now I'm not saying that this is something necessarily good to do. Times were different then, huh? Right? So, so I said, I will deposit it in the bank and borrow the equivalent amount. What interest rate are you willing to lend me? Now, this is a bank I had been dealing with for years, since I started to work. And they tell me 18%. I said, are you all mad or crazy? I said, I have everything in this bank. I have been with this bank. 18%? That's the same bank that increased my credit card, right? Not a very user-friendly bank. I'm not telling you, but I'm sure many of you all know which bank it is already. So again, I had walked across the road, went to this other bank, and this now was my first interaction with this bank. First time going into this bank, and I walked in and said, I have this amount of money, I want to deposit it, and I want to borrow it back. How much are you all willing to lend me? I said, the bank I work with was telling me 18%, and that is ridiculous. How much are you all willing to lend me? They said 9%. Praise the Lord. Right? Sometimes we don't understand our power. I didn't even have an account with that bank, right? So we could negotiate some of the things we want, and we could try to negotiate some prepayment. If they want to play hardball, then you don't have to go with a bank necessarily. Credit unions offer mortgages, TTMF has mortgages, and with both the credit union and TTMF, they don't have any prepayment rules. In other words, you could pay extra at any point in time. All you have to do is tell them that, listen, this is the what's principle. Somebody's saying no. Yes, they do. I have done this with a lot of clients who have benefited from doing this, both at TTMF as well as in credit unions, right? But the banks might give you some more challenges. So when you're taking a mortgage, here's what you do. Now, also, I should make it clear though, this, what I'm telling you, works best at the beginning of a mortgage. Because at the beginning of a mortgage, the principal payments are very low. So it means that any payment that you make could stretch very far. At the end of this mortgage, if you make a $250 payment, it probably ain't really doing anything, right? So to really maximize and benefit from this, you want to do it at the beginning of a mortgage. That's when it's best. And like I say, I know somebody who did it towards the middle, well, a little before the middle of their mortgage, and they were able to pay off their mortgage about, I think it was about 7 years early. They paid off their mortgage, it was a 20-year, and they paid off their mortgage 7 years early. They were with a credit union, and they were able to do this, right? So, again, At the beginning of a mortgage is the best time, and TTMF and the credit union would allow you to make these types of payments. So therefore, you may want to start, saving in the credit union a little bit more, getting the surpluses and deposits in the credit union that you are able to borrow. So what are some tips on mortgages? Firstly, you want to borrow as little as possible, and you want to make the payback as short as possible, subject, of course, to what your budget can afford. Then, you want to look for a mortgage with no prepayment penalty and try to add something extra to the required payment. And shop around for the best deal, remembering that most credit unions offer mortgages with no prepayment penalties. All right? Any questions so far on credit cards or mortgages? Yes? Mm-hmm. Right. Right. We're talking about the penalty payments. Thank you. If you make a late payment on your mortgage, of course, and late payment on anything, late payment on anything, you get hit with the charges. Any other question or statement or comment? Okay, yes? Yeah. No, Vicky, before you go ahead, is there a mic that everybody can hear what was being asked? Is there a roving mic? Vicky, you have to develop a preaching voice, lady. Okay, wonderful. All right. Oh, this one here? Okay.
My question was, you were putting the $250 extra each time there, and you were seeing the benefits. If you were taking that $250 and saving it to pay lump sum on your principal, how would that affect?
Right. Now, if you're saving it to pay principal, remember, time is going as you are saving. So, as time is going, your payments, you are continuing to make payments in the mortgage and paying the higher interest. Let me just go back to show you. Right? Right. So while you're waiting to save up the 250s and the 250s and the 250s to make a lump sum, unfortunately, you are continuing to make the monthly payments and still paying the 960 and the 936 and whatever. So if you are able just to send for the 250, put it through. Right? If, however, your mortgage doesn't allow you to do it on a monthly basis, then do the best that you can, which is accumulate it and then make the lump sum payment, yeah. But once you are able to make the payment every month, then go ahead and do it so you don't have to end up paying those higher interests. Especially, remember, the earlier in the mortgage is the higher the interest. So the longer you wait, you have been paying higher interest going forward. Okay? Any other question on the mortgages or credit cards? Yes?
So therefore you're paying on the principal.
Yes.
On the interest.
Correct. And you specify that when you're sending the payment through, you tell them you want it to go to principal. Because let me tell you what the banks do sometimes. You send through extra, you're going to put it in a suspense account. Right? So you have to tell. I mean, they know very well what you're planning to do, but you didn't say it, so it goes into suspense. Right? So you have to tell them that you're putting it towards principal. Okay? Any other question? Yes? I would say yes, in case they don't read it. Yes. Well, yes, please use the mics, please. Yes, so that everybody can hear and benefit from the points. Or comment.
Right. If you have a question or comment, please walk to the microphone.
Yes.
Thank you. Come, Nicole. Oh, sure. Okay.
Any other? Okay, there's still an opportunity later on if you think of your question then, all right? So we looked at mortgages, and now we're looking at getting out of debt. So you find yourself in a situation where you have a lot of debt, it's a little overwhelming. How do you get out of it? Well, let's do a little quiz. So you open the bathroom door one day to discover several inches of water on the floor and water overflowing from the sink where the pipe had been left on. What do you do first? A, hold on. Do you grab a bucket and start mopping up? Do you call the ODPM for help? Do you turn off the pipe, or do you sit and cry over the situation? I'm hearing turn off the pipe. How many say turn off the pipe? How many say something beside turn off the pipe? Okay, turn off the pipe is correct, right? We're going to start by turning off the pipe. And yes. Right. Okay, you can turn it off while you're crying. That's okay. That's quite allowed. That's allowed. So that's what we do when we talk about getting out of debt. We start by turning off the pipe. We start by stopping new debt, right? Stop all borrowing. You're going to use cash only. And I'm saying cash only here. You can use your card, You can use your credit card, you can use your online transfers and so. But just make sure, what are you going to make sure if you use your credit card? That you have the money in the spending plan to pay it off, right? So you use on your credit card only for things that are in your spending plan, right? So we stopping new debt, we turning off the pipe. Now we're going to start mopping up, right? And we're going to look at reducing the existing debt. This is where we take all the extra water on the floor now and we're getting it off. We do this by consolidating loans. Now, when we talk about consolidating loans, say you have two loans. Say you have a credit card debt and you have maybe hire purchase, right? So let's say you have a 5,000 hire purchase loan and you have a 2,000 credit card debt that you're paying on. If you are paying just the minimum amount to those two things, you would find that it works out to quite a, well, let me not say it works out to quite, but okay, let me put it this way. So you have those two loans, the hire purchase and the credit card, working out to about $7,000 in total. If you were to consolidate those loans into, for example, a credit union loan, where you borrow $7,000, pay off the hire purchase, pay off the credit card, and now just pay back that one loan to the credit union, you would find that the payment you are making to the credit union is less than the amount that you would be paying, the sum of the two payments to the credit card and the hire purchase. Is that clear? Right, good. So when you consolidate loans, you free up money on your spending plan, okay? You can also use assets to pay off debt. So for example, if you just have this outstanding credit card that you're paying just the minimum amount every month and it's going on and on and on, you might say, okay, I'm paying 22 or 24, 26% on this credit card, and I have a savings account, all things being equal, right? All things being equal, depends on your personal circumstance, right? I have this savings account that's getting, how much to pay now on savings accounts? 0.000 something, right? So you might opt to use the money from the savings or use some of the money from the savings account, pay off the credit card, and then you use what would have been the minimum payment to the credit card and start to build back up the savings account, yeah? In that case, you would have saved quite a lot of money that would have been interest payments. And work with a spending plan. When you work with a spending plan, you are able to manage this process a whole lot easier. So, having turned off the pipe and mopped up the floor, now we're going to pay off all that. This is where we're going to clean up and empty all the water in the sink now and fix the pipe, right? We're paying off all that. And we could do this by using the snowball strategy. Anybody ever heard of the snowball strategy? It is so simple. Now, it sounds confusing when I'm going to read it to you now. It's going to sound confusing. Forget how it sounds, and I'll walk you through an example. It is so simple that people tend to think, this can't work. It works. It works. I've seen it work for a lot of people, myself included. All right? So let's see how it goes. With the snowball strategy, you start first by making a list of all of your debts. You're going to rank them from the highest interest debt to the lowest interest debt, including the outstanding amounts and the minimum monthly payments. Then you're going to start by making at least the minimum monthly payment on each debt. Remember, we said that we are required, the Bible tells us we have to pay what we owe, right? So we're going to make at least the minimum monthly payment. But we are going to focus on the smallest high interest debt first. And we're going to use all extra money towards this debt. And when this debt is paid off, we're going to use that monthly amount towards the next debt on the list. And as debts are paid off, we keep increasing the payment amounts to the remaining debts one at a time. Let me walk you through how it works. So you start by making a list of all of your debts from the highest interest to the lowest interest. Usually you would find that the ones with the highest interest tend to have the smallest amounts outstanding, right? So in this example, you have a credit card with an outstanding amount of $7,000, hire purchase $9,500, credit union $40,000, and mortgage $250,000. And the interest rates range from 25, 18, 12, and 7.5. So we said we make the list, so we have made the list. We're going to start by paying the minimum amount on each of these. So we're going to keep paying our minimum amounts. We don't want, as Christians, to not to pay what we have borrowed. But we're going to focus on the smallest or on the highest interest one first, which in this case is which one? The credit card, the highest interest, right? And any extra money that we get, so the Lord bless you, somebody give you a little something to hold for your birthday, or some back pay, or Pastor Moses. I'm not talking to the SEC workers now, I'm talking to the family members, okay? The back pay. Right? Some back pay comes in, public servants supposed to get back pay, so anybody who has a family member as a public servant, when the back pay comes in, or even as you work with your spending plan and you free up money, you're going to put everything that you have extra towards the credit card. By doing that, now remember, you're not borrowing anymore, so that the outstanding amount's not going to go up. Or even if you use the credit card, you're paying it off in first, so the outstanding amount would remain $7,000, right? So as we put all the extra money towards the credit card, we are now accelerating the payback for the credit card. And when we do that, we would find that, okay, in 2 twos, the credit card is paid off. We don't take that $300 and go and celebrate. Not yet. Celebration will come. What we do now is we take that $300 and we add it to the payment that we are making to the hire purchase loan. So instead of paying back $450, we now pay back $750. What are we doing when we do that? Again, we are accelerating the repayment and working down that loan even faster. And we do the same thing as this loan is wiped out. We don't go and take something else on hire purchase. Instead, as it's paid off, as we continue to have extra money, first of all, this $750 now goes towards the credit union and any extra money that we have, of course. So the credit union amount is increased from $1,050 to $1,800. And same principle again, as we pay off the credit union, we now repay the mortgage. So our payment almost doubles from $2,250 to $4,050. And we could see how we could save a whole lot of interest and a whole lot of months and pay off our mortgage faster. Does that sound too simple? It works, you know. It works. Right? So, any question on the snowball strategy? Does it seem like something you think you could do? Yeah, it's workable. It's not such a hard thing, but I must tell you, it takes discipline. But you know the nice part about it? When you finish with the mortgage, you now have $4,000. Oh, you can play yourself, right? So it just takes discipline for a period of time. And at the end, when the goal of being debt-free is accomplished, then you could reap benefits. And I would recommend to anybody who is getting ready to retire, if possible, try your best to go into retirement debt-free. Retirement has its own challenges, so we don't want to add, the issue of high debt when you retire, okay? So what are some guidelines when we're looking at borrowing? Well, firstly, avoid borrowing for items which depreciate faster than the loan decreases. Give me an example of this. A car. We didn't do it today, and like I say, only if we have time at the end, we'll do the car loan. But cars, certainly, right? So if you have to borrow, again, cars are expensive items. So if you need to borrow, then, well, you start off first by relooking the type of car maybe that you purchase, right? Remember, all the cars are going to get you from point A to point B. One may get you there in a little more comfort, but they're going to get you to point A to point B. But the thing about the cars as well, if you are going to borrow to purchase a car, try to increase the deposit. The banks require 10, some of them require 5% or even 0% now in some credit unions. If you could increase the amount that you put as the deposit, it would make your situation a little better. And like I say, if you have time at the end, I'll walk you through an example to show you how this is, okay? Avoid using debt for consumptive items, such as vacation. What are you going to do instead? Save for it. Wonderful. Borrow only when the item will bring a benefit more valuable than the cost of borrowing. So education is one of those things. Or like I said, any investment that has a fixed return where the return is is more than the cost of borrowing. Try debt consolidation to help manage debt. Pay off debt as quickly as possible using the snowball strategy, and contact lenders if you are having problems making payments. It's not going to go away if you just leave it, right? We now have what we call credit ratings for individuals. TransUnion does that. A lot of companies, they subscribe to TransUnion, and they would look to see what is your payment, what is your payment history like. And that is used for two things. It is used to determine, first of all, if they're going to lend to you, how much they're going to lend to you, and the rate at which they lend to you. Because even with mortgages have, the rate for a mortgage has two components. One is a fixed rate that central bank sets, and which is the MMRR, and the flexible one is the one that the bank sets based on their history with you. And one of the things that they would look at is your repayment history, right? So if you're having problems, talk with them. Think about it. The lenders want to get their money back, so they'll be willing to talk with you and work out terms that will help you be able to pay them back. All right? So having gotten out of debt and hopefully freed up some money, we could now look at saving and investing. But any other questions on debt management? Okay. Like I said, any questions I'll come up towards the end afterwards. So we now want to look at saving and investing consistently to meet our goals. Proverbs 6:68 tells us to put aside for the future. It says, "Go to the ant, thou sluggard, consider her ways and be wise, which having no guide, overseer, or ruler, provided her meat in the summer and gathered her food in the harvest." We know that we work for a period of time and then we no longer work. You find that people are living, okay, well, I'll come to that in a little bit. Right, well, I'll come into it now, actually. Now, there are three main challenges that people find in retirement. The first one is longevity. People are living longer, that's the fact, right? Not necessarily healthier, of course, except in the Adventist church, right? We have a health message, so yeah, we live in good and healthy. But people are living longer. So you find what could happen is that while you may have worked for 35 or 40 years, you could spend an equal or even more time in retirement, which means that you have to make sure that whatever provisions you made in your working period can take you through this autumn period when your income is going to be fixed, because that's another one of the challenges, the fixed pension that people have. Right? So your income is fixed. With increasing cost of living because of inflation, it takes some really good planning and management to do this. Also, keeping in mind that healthcare costs, because as you age, a lot of people, as they age, sickness takes over. Yes, you can get free healthcare in the public system, but we know how that works. The nurse in the newspaper recently who works in the center that does the scans said she couldn't even get an appointment for her. She's the head nurse in the center, and she had to have a 2-year wait to get her appointment for a scan. If you choose to go private, we know it's expensive. So these are some challenges that we find in retirement, and we want to see how can we counteract that. The question that people ask, and it is very important, is how much money do I need in retirement? There is a way we could work it out, and that's what I tend to do for most companies. Most companies that hire me would do planning for retirement seminars, and we would actually work through this. Unfortunately, the time doesn't allow. Past Mobis, maybe another time, we could do specifically the retirement planning work through. We work it through by firstly determining we could actually estimate our expenses during retirement. I'll just tell you, but I wouldn't work it through. What you would do is you take your spending plan and you will look at and update it based on what expenses you expect to have in retirement. We know, for example, some of the things we pay now, we're not going to be paying in retirement. Things like your NIS and all those. Your tax will go down. Maybe some of the money you spend on transport and so would go down, right? Other deductions, health surcharge, all those things will be gone. But you want to be guided by your retirement goals, right? So we look at the spending plan, we take out the things that wouldn't be there at retirement, we add in the things we want to be there at retirement, and then we use inflation to work out exactly what that cost would be. That's for another day, unfortunately, right? But certainly we could look at the income part of it. Now, who provides your retirement income? I'm going to give you a hint. There are three main sources for your retirement income. Tell me, what are those sources? Okay, tell me who provides it first. Government provides one, right? And what the government provides? The NIS. What else? Who else provides income? Your insurance company. How do they provide that? Annuity. So it's therefore you providing it because you are the one taking out the annuity. So you provide also for your retirement income. And who provides the third arm of the retirement income? Who? Employer. Very good. So the government, which would be your NIS retirement pension or grant, your employer, which would be your employer pension. Some companies have savings plan or even stock ownership plans. And of course you. Right? You can do your deferred annuity, your investment income, your business income, anything else will come from you. So how much are you actually getting? Well, we look at the main sources of retirement income to get an idea as to how much. National insurance, how much are you going to get from that? Well, if you make 750 contributions or more, you can get a minimum pension of $3,000 a month. If, however, you were in the high bracket, in the, I think it's class 16, your pension will be about 4,000 plus. Also, if you work for very, very long, you can get increases or increments for every 25 contributions above the 750 contributions, there's an increment. Now, with the increments, it will take a while before you start to go above 3,000. Simply because 3,000 is the minimum pension, but it is not what we're supposed to get. We're supposed to get less, right? But if you work for very long, there are increments to be had, and you could get up to 4,000. I know somebody getting 4,000 too, right? This payment continues for life, and it is not taxed because it is not considered to be income. That's how the government looks at it. It's not considered income, so it's not taxed. If you have less than 750 contributions, you get instead a retirement grant. Now, this grant is 3 times the value of your total contributions or 9 times your contributions. Why is that? You see, every time you make a payment to NIS, you pay 1/3 of the amount and your employer pays 2/3 of the amount. Right? So therefore, if you look at what you would have contributed, it's supposed to be 9 times your contributions. And if you look at what you and your employer would have contributed, it would be 3 times. And that is a one-time payment subject to a minimum of $3,000. So it all depends on your number of contributions. Now, this is for non-SEC workers now. If you have family members who are working, I found out something some years ago, especially for people, actually I saw it most, believe it or not, in people who were working with small oil contractors, small contractors working in the oil industry. They would tell the employees, listen, we could either pay NIS for you, right, and you get a less salary, or we don't pay it and you get a higher salary. Now, when somebody is young and starting out, they're not understanding the consequence of this. Not to mention it's against the law for an employer to do that, right? But when they do that, the average young person says, hey, I want more money. Forget the NIS. So you may find somebody would have worked for quite a while and not have the number of contributions. You also find that what happens is employers deduct it from their employees' salaries and they don't return it. What I recommend for everybody, now, like I said, non-SEC workers, request a statement of your NIS contribution. In fact, even if you are a SEC worker, because sometimes NIB makes mistakes, right? So don't wait until you're ready to retire and now go and get a statement and recognize that there are mistakes on it. They take a little while to fix mistakes. So everybody could just, no matter where you are, go and request a statement. Make sure it's accurate, but more so if you are approaching retirement. Okay? Make sure it's accurate, and there are things that you can do to put it back on target, such as taking your TD4s in and letting them make the adjustments. So the employer pension, well, I wouldn't go into this because I'm guessing you would figure this more out. You will know more about this than I would. But keep in mind, though, by law, your pension cannot be any more than 2/3 of your final income, right? That's by law. The other thing that happens with your pension is that you are allowed to have either a full pension or a reduced pension with a tax-free lump sum, right? I would strongly recommend that everybody considers the reduced pension with a tax-free lump sum for a number of reasons. One, tax-free always sounds nice. And secondly, you could actually use that tax-free lump sum in such a way to supplement back the reduced pension, and you almost don't really lose anything, and you have a lump sum that you could use for some purpose or even bequeath or just have it there earning and supplementing your pension. That's the purpose of this, actually, to help you invest it, you have something to invest which would now supplement your pension, keeping in mind that it's now a fixed pension over a period of time. So as I said, with the government, it's a minimum of $3,000 per month, maximum of 2/3 of your final salary with your employer. And you are now responsible for the rest. And I'm going to try in the next 10 minutes to finish up this retirement segment. So the first thing you could do is you could have a business. Businesses, traditionally, we are told, are very risky. Why? Because the majority of businesses don't survive 5 years. However, the fact is that there are many businesses out there doing very well. So what is important is that we plan, we do proper planning, proper marketing and a business plan to be sure that our business is the one that is profitable. We do that by making sure, first of all, that we meet a need. And not only that we are meeting a need, but that we are meeting a need at a price that people are willing to pay and that will give us a profit, right? Make sure and do your research. I personally am very partial towards using what our church represents for businesses. For example, we have the medical missionaries, the right arm of the gospel. Anything with health. And if you recognize, during COVID, what remained open? Food, health, hardware. Right? So when we talk about health, right, any aspect, there's a continuum along the line for health. There's a continuum for food. For example, you could, let's say food. Everybody, we are counseled by the spirit of prophecy to plant our own food, to become self-sufficient for the time when we're not able to buy and sell. So you should go to the country, buy a piece, be self-sufficient. For the time when we can't be self-sufficient and the Lord comes and we are totally dependent. But you could start from the one end, being the farmer, and providing a raw product. So you plant and you provide the lettuce and the pak choy and the whatever. You can choose to do some primary processing, and you buy it from the farmer. You reduce some risk there, because if that farmer loses his crop because of flooding or drought or insects, you just go to the next farm. It sounds a little harsh, but it's business, right? And you buy from that next farmer and you do minimal processing, which is maybe some sorting and washing and packing. Add some value there and earn. Or you could go a little longer along the continuum and say, okay, I'll do some secondary processing. So instead of just sorting the pak choy and putting it in a bag and selling it, maybe I could start to cut it up and do some pak choy packs, so callaloo packs like we see in the grocery, and cut up this and the soup packs, and we put it all together. Or you could even go a little further along the continuum and say, okay, maybe I'll do tertiary processing and change the product altogether. And we start to do all the patties and all the vegetarian meats and the nut products. You could go anywhere along that continuum, right? Food, people always want food. health as well, right? You could go into maybe the herbal remedies. You could go again along the continuum from as little as providing the herbal remedies to opening a lifestyle center. Anywhere along there, because we know these are the things. Remember, we're talking about meeting a need and remembering that in times of emergency, in times of problems, what are the things that always stay there? What are the things that people want, all right? But of course, there are other things that are needed. We know in the country right now, people are living longer. So maybe focus on the aged. How can you help the aged? Maybe a transport service, maybe a shopping service. We know crime is an issue in the country, maybe some aspect of security. In other words, do your research, do your marketing to make sure whatever business you go into would be successful, because there are successful businesses. Let's not just jump into something, let's do our proper planning. Then we have the deferred annuity. Now, with the deferred annuity, I just want to make 2 points on this one. You could have either a registered annuity or an unregistered annuity. An annuity really is a flow of payments. So what it is, when we talk about deferred annuity, it means that you are saving to get a flow of payments sometime in the future. So you're deferring that flow of payments, right? So you're saving now to get that payment going forward. And for people who don't have an employer pension, this is very useful for them to contribute to a personal annuity or a personal pension that they could save, and then when they do retire, they have money every month. Annuities can be either registered with the Board of Inland Revenue, or unregistered. There are some similarities, there are some differences, and I'm going to just tell you what those are and tell you how you're going to use them. The registered ones are offered by banks and insurance companies, flexible payment options, tax-free lump sum of 100% interest and or 25% accumulations. The unregistered, similar flexible options, tax-free lump sum, but those are offered by insurance companies alone, right? So that's the first thing. Where they are very different now is that with the registered annuity, you get tax relief on your contributions to a limit. The limit now by law is $60,000 for the year, which is made up of contributions to your pension, contributions to your annuity, and 70% of your contributions to NIS, right? So you get tax relief on the contributions. However, the pension is taxed for life. Right? Sorry, the pension is for life, the pension is taxed, right? As opposed to the unregistered, where you get no relief on contributions, but you get a tax-free pension. It's important when we're doing our planning to recognize the difference between them and to use it on a, so say for example, if it is that your income level is such that you don't need to get tax relief on contributions. So we know now that the personal allowance as of this year is $90,000, which means that essentially anybody working for $7,500 a month or less gets it tax-free. We know that we can make deductions for things like deeds of covenant. I know some people not everybody is happy with it, but as I always say, when the Lord tells me to return my tithe and offering and he will open the windows of heaven and give me a blessing, I'm taking the blessings however he sends it. If the deed of covenant stops, it doesn't stop me from making returning my tithe and offering, but as long as he gives me the blessing, hallelujah, thank you, Jesus, all right? So, if it is, you know that with a $7,500 income or less, so you're not paying tax, it makes no sense taking a registered annuity. Why? Because the benefit of the registered annuity is tax relief on contributions, but you're not paying any tax. So you are now getting a benefit that you cannot use, but then when you get the money out, you have to pay tax on it. So it's a lose-lose situation, right? Or even if your salary is more than $7,500, if you have other deductions, like I said with the deed of covenant, for example, and there are other ones that you can use, if it brings your tax down where you don't need an annuity to reduce tax any further, then don't go with the registered, because again, it's a lose-lose situation. In that case, you can go with the unregistered annuity. And with the unregistered, there's no tax relief because you don't need the tax relief, and you get your pension for life. Is that clear? You want me to say it again? Yes. Okay. So with the annuities, you have registered annuities registered with the Board of Inland Revenue. When you register it with the Board of Inland Revenue, what it does, it says that, and you would see it on the statement, this person contributed an amount to this type of annuity, which is a registered one, so we're going to give them tax relief. So when you're filing your income taxes, you get a statement from the insurance company or from the bank saying, Rhonda Reid-Hylegar would have contributed $5,000 or $6,000 to this annuity, and this is the receipt saying such, and when you file your taxes, you can now get a reduction in tax. And this can be done actually when you are doing a TD1. So in other words, you get the tax relief in advance, right? If, however, my income is such that I do not pay tax or I pay minimal tax, it means that if I still contribute $6,000 every year to a registered annuity, I will get a statement at the end of the year saying that I can reduce my taxable income by $6,000. But when I go to do my tax return, I will see that I do not even have $6,000 in taxable income. Okay, let's translate this into actual taxes. At a marginal tax rate of 25%, a reduction in taxable income of $6,000 translates to a reduction of $1,500 in annual tax. So, if I contribute $6,000 to a registered annuity, I will get a $1,500 reduction in annual tax. But when I go to do my tax return, I realize that I do not have $1,500 in taxes to reduce because I paid less than $1,500 in taxes. And if I paid less than $1,500 in taxes, I cannot deduct more than $1,500 in benefit. It doesn't go into a negative to give me a refund. It just reaches to zero and the rest is lost. Following me? Is it a little bit clearer? So it means then that I have a benefit which allows me to reduce my tax by $1,500, but I do not pay $1,500 in tax for the year. I pay less than that. So therefore, part of my benefit is going to waste. So you would have to pay tax on that. So what would have happened essentially, you would have lost the tax benefit earlier on, and you have to pay tax now. So it's a lose-lose situation. With me? So the better thing to do in a case like that would be to take an unregistered annuity. It is not registered with the Board of Inland Revenue. You just have it directly with the insurance company. You make your payments. When it is time to get your annuity, they just convert it. They give you your money every month. It's tax-free. No taxes to be paid. So again, it's part of the balancing act which you do when you are working on your retirement plan. You could see whether I need to have a registered or an unregistered, or sometimes maybe both. You have a certain amount of a registered annuity and a certain amount of an unregistered annuity. Is that clearer? Yeah, not sure? Okay, well, yes, question?
In terms of risk for either of them, or is there any greater risk for either of them in the end? Let's say perchance the insurance falls through, as we have had for so many other cases where they have certain schemes. Will it affect your unregistered plan as against your registered plan?
Right. Now, in that case, thank you, Pastor Andrew. That's a really good question. Now, with traditional insurance products, which would be like your regular annuities, these types of deferred annuities, there's something called a statutory fund, right? And pension products especially are covered, whereby any monies that are used towards pensions are considered to be held in trust. And once they're in trust, it cannot be used by a company for anything else. So even if a company is going under and failing, they can't touch pension monies, right? So these would be safe. Where you would have the challenge is CLICO, if you remember, had something that was outside of this. It was the, what do you call it, the executive, the EFPAs, the executive, flexible premium annuities, right? The executive flexible premium annuities. Those function a little differently in that what those things were invested in were, of course, much riskier to give you the much higher returns. So those were outside of the traditional insurance policies. So that's where you would have your risk. But once you stick to the traditional policies, no, you'll be okay. All right? And the benefit too of an additional benefit of the registered, of course, it's all under central bank, but these are held in trust. Okay, yes?
Is there a minimum time period if you want to go into a pension annuity?
With the annuity, most of these, with the flexible options, allow you to save up to age 70. Right? And you can convert to it by age 70. However, depending on the time you start, it may not make the most sense to do it. Like if, for example, you're already in your late 60s, it mightn't make sense, and I'll show you why in just a slide or two, right? The great benefit of these is if you start really young, because of the whole idea of compounding and the exponential growth that you get from compounding, right? And we'll see that in a bit. But certainly you can contribute up to age 60, and they're flexible. So even if you start off and say you want to do it at age 55 or age 60 and your circumstances change, you could apply to either extend the time or to bring the time up a little bit more. Okay? Any other question there? Yes?
This is more on the retirement. What counselor advice you can give if one seeks, or let's say his decision or her decision will be into in terms of retiring in a place that is where he's not currently working, where maybe the cost of living might be higher. Is there any interruption in the payment or anything? And I'm looking at the NIS or so forth. Is there any policy or anything like that if one chooses to work or retire in a place that where he's not currently working? Is anything?
Right. Well, the thing is, the main thing with the NIS is to make sure you have a number of contributions. And you would need to be working for a minimum of 14 and a half years. 14 and a half years of payment to NIS would guarantee you the 750 contributions. I shouldn't say 14 and a half years of working. 14 and a half years of working and having contributions paid. Because like I said, sometimes you do have some employers that are unscrupulous and don't return the payments that are made by the employees. Once you start to get that payment continues for life. Right? So you just need to be sure that you have your number of contributions in. There are some countries that we have agreements with, like in Canada, for example. If you go to work in Canada, the payments that you would make to the system, they can be counted here as well, right? But you have to see which country and which bilateral agreements are in place. So if you don't have the 750, that payments there could be counted towards your 750, all right? Okay, so I'm watching, I'm a little behind. So if there's no other question on this, I'm going to go ahead a little quickly to try to finish retirement, and then we look at investment. So it's investment, we're on time. So the other thing that part of retirement income would be investment income. This is what you are responsible for. Now there are some types of investments that we need to avoid. Proverbs 13:11, sell to wealth gotten by vanity shall be diminished, but he that gathereth by labor shall increase. It also talks about in Deuteronomy about lending. Do not lend upon usury to thy brother, usury of money, victuals, or anything that is lent upon usury. Now, why am I saying this? I have found a lot of people tend to be very, very interested on high returns. They get carried away by how much money you could make. Sometimes we have to be more interested in the return of our money than in the return on our money. Because when we run after high returns, we end up in some not so nice situations. Especially when, remember, it's not even ours to begin with. We are just managing it. We are stewards. So we need to take this counsel very, very seriously. We have warned against speculation. Spirit of prophecy tells us, and this is on Councils on Stewardship, the idea of accumulating substantial means by the moderate gains of industry and frugality is an idea that is scorned by many as no longer suited to this progressive age. We don't want to work, they're saying drop, fills the bucket. We don't want to drop. We want to just open the hose on it, right? And that gets a lot of us into a lot of problems. It says that God desires, and this is from Upward Living. I think it's Upward Living, Upward Look? Upward something. Pastors, help me. Upward what? Living or look? Upward Look? All right. God desires his servants to avoid all speculation. Satan may pave the way by making the first investment successful, but oh, how bitter will be the final outcome. If the professing Christian has success in his first speculation, his ruin is almost certain. Visionary schemes are widely entered into as schemers present promising enterprises, which they declare will pay a large percentage on all money invested. Good men are fascinated and deceived. I don't know if you all have ever heard about, the Forex investments, for example. That you put in, say, 500 and you get 5,000. Now, I don't know what you could invest in that you could put in 500 and make 5,000. And if you are putting in 500 and making 5,000, it means there is somebody else or some other people that are losing 5,000 to give you your 5,000. And that's not what we should be doing as Christians. There are a lot of investments online, the cryptocurrencies, the bitcoins, all these things promise high returns. And don't get me wrong, people do get some high returns. But that is exactly the trap. That you get the high return the first time and you keep going. It's like gambling. You keep going after it and it doesn't come again. I did a retirement planning program in a Pentecostal church about a couple of years ago. And there was a guy there when I was speaking about it, and he said he had to confess. He said he is the one who started off one of these schemes. He said, folks, you all are my brothers and sisters in Christ. This is in the Pentecostal church. He said, you're not going to make any money. He said, I'm the one who will make money. He said, I have made a lot of money. He said, the people who start and come in at the beginning are the ones who win. Everybody else loses. He said, so I am telling you all, don't do it. Right? It looks good. And like I said, somebody you know would have benefited. And you feel that maybe you could. This is where we have to undo some of our thinking and rethink according to the word of God now. If God says don't do it, if his servant says don't do it, then don't do it. All right? Remember, it's not our money anyway. So the secret in going wealth, as the saying said, you want to do it gradually. It's the principle of compounding, which is earning interest and interest that was previously paid. That's if you're going with these type of investments. It's another way we'll see just in a little bit. Now, how does this principle of compounding work? If you're saving $100 at the end of every month in some instrument that's earning 6% interest compounded money monthly, this is how it will grow. So I want to look at a couple of periods here. After 5 years, you would have accumulated 6,977, and after 10 years, 16,388. So the period of time would have increased by 2, but the amount of your accumulation, would have increased by 2.3. If we look instead at the period 5 and 20 years, by 20 years, your accumulation would be 46,208. So the period of time would have increased by 4, but the accumulations increased by 6.6. If we now look at it for 35 years, the period of time would have increased by 7, but the accumulation would have increased by 20.4. What are we recognizing here? What's a principle we could take from this? principal. What's that? The longer you leave it, the more it grows. Which is why it's really good to start early, right? When you start early, and this is what point I was saying, when you start your annuity very late, you may not have the benefit of time to really get the effect of compounding as opposed. So I'm not telling you don't do it, but I'm just saying you would not get the kind of return or the kind of contributions you may have to put in to get the return that you want. It may not always be feasible. It's really better to start younger and to do it for as long as you can. Okay? So the guideline would be start investing as early as possible, invest for as long as possible, and try not to withdraw any interest earned. That way, we could see the benefit of the compounding. Okay? So what's the difference between saving and investing? What's the difference? Anybody want to try a guess? Okay, now you're going to have to use the mic, right? Come on, go use the mic. Anybody? All right, interest of time. Saving is where we put aside money for specific goals, usually short to medium term goals. Things like building an emergency fund, saving for an event like a vacation, or saving a deposit or a down payment like for your mortgage. And because it's a short-term goal that you have, you would use low-risk options, things like your income funds and your fixed deposits. Now, people ask about should we save as Christians? So yes, saving is encouraged. Hoarding is not. When we start a hoard, then we become the doubtful, right? But certainly savings to meet a need is encouraged. When we talk about investing though, investing is putting your money with the intention, to put it to work with the intention of growing it. And this is usually for the longer term goals like retirement and children's education. And here's where you could use some higher risk options. And that's one of the things that I find people tend to confuse a lot because they don't understand the whole idea of time. Remember we talked about the beginning, the goals, time? You must always match the goal, the time frame of the goal with the time frame that the product is meant to be used for. So you would not use a product that has a long-term span for a short-term goal. And I'll show you this in a bit. So what are some of the products and instruments that we're talking about? We're going to look at three categories. The safer ones, which tend to be used for the short-term savings, like your deposits and your vacations and all those things. We're going to look at the riskier ones, which are for the longer-term goals, and the riskiest ones, which we try to avoid, okay? So we talk about treasury bills. I don't have time to really go into all of them. I'm just going to show you, right? This is what you would see in the papers. Treasury bills are basically the safest investments that you can make. It's offered by the government of Trinidad and Tobago. It's guaranteed. Can't lose money. However, it's a short-term investment, usually 91 days, 182 days, or 364 days. So 3 months, 6 months, 1 year. As you can see, the returns are very low. Everything is a low return these days, so it's relative. They're all low. But you tend to get lower returns. Right? You don't get interest on this. Instead, you get a discount. So you get your equivalent of interest payment up front, like a discount. You know, when you go in a store and you buy a shirt, it's $100, you get a discount, so you could get back $5 in your pocket. With the treasury bill, you get the discount up front, so you put that back in your pocket, and then you do investing. Then you have government bonds. These are safe. Again, they are guaranteed by the government of Trinidad and Tobago, but they are for longer terms. These are some old ones I'm going to show you. So this one, for example, is, it doesn't say how long. Oh yes, it was issued in 2011, due in 2031, that's 20 years. So this is a long-term investment. Again, another one here. And you would see, by the way, it's a government bond, so you know it's a safe bond. This is one by NIBDEC. This is a 16-year one. Again, you will see it's not a government bond, but if you can see, just below where 16-year, you see for auction, and then below that, you'll see guaranteed by the government of Trinidad and Tobago. So that's a safe one. You could use these for longer-term investments. You have fixed deposits, which I think most of us might be aware of. Fixed deposits, you put aside the money in the institution, be it a financial institution or the bank or wherever, and you keep your money for a certain period of time. You don't have access to it, and you get a return. The longer they keep it, the higher return. You have fixed income funds, similar to like our National Investment Fund, the NIF. Now, the NIF is I call it a really nice investment. It gives you a fixed return. Well, Sister Yvette, how should I put this? It's fixed, but it can be less, right? It can be less because it's set up as a bond in terms of how it's doing the payments, but it invests in the stock market. So it's a little risky. However, I think the rates that they would have put here, they're almost guaranteed to get the returns. And I know the persons who would have taken the smallest one, the 5-year one, they would have gotten back their monies already. They would have gotten back all of their interest and their lump sum payments and their capital payments, right? But these are some of the funds that we could look at. Why? I'm going to use a term that I don't even like to use, Sister Yvette. When the government puts out these things, it's meant to encourage John public to invest. So unit trust was one of those things the National Investment Fund is. So I would tend to err on the side of if something is going wrong, they're going to step in, right? Might not. But these are considered fixed income. Like I said, even though the interest can go below, more than likely it will not. And it hasn't so far. And then you have your mutual funds. Now, mutual funds, we need to be careful in terms of recognizing the type of mutual fund for the need that we have. So, with a mutual fund, how it works is like this. You have a large number of investors who pool their money through a company, and that company has a fund manager who uses all the pool funds and now invests in a collection of stock and bonds according to different profiles. So they might do it by industry. So you might have like an energy fund. They could do it by geographic region. So you could say you have an India Asia fund. We had that at one point in time. Or you have a BRICS fund, or you have a North American fund, or a global fund. Or you could do it by risk profile, meaning the income fund for the lower risk, or the growth and income fund for the slightly higher risk, right? The benefit of a mutual fund is this. Say a share in Republic Bank. That is now valued about roughly $120. So it means that if you free up the $250 a month, you could just buy 2 shares in Republic Bank. And while it might give you a good return, most people don't want to go to a broker to buy 2 shares. When you go into the mutual fund company, say I'm going to use unit trust as the example again because most people are familiar with unit trust. Their fixed income units sell at $20 for one. Their growth and income, it varies, but it's around $18, $19 now for one unit. We're looking at the growth and income fund. They would take that $250, but they are investing. So you would get a little bit of Republic Bank, a little bit of First Citizens Bank, a little bit of Massey, a little bit of, who else is on the stock market? A whole lot of companies. So your exposure is wider. You have spread your risk a little further. But even though your return may be lower than investing directly in the Republic Bank, your risk is also lower. You with me? Okay. So let's look at this. When we're talking about the safer products, we're talking about the income funds. These are the mutual funds that invest in these things that I have listed here, together with things like overnight lending and commercial paper and those types of things. They invest in safe products, and of course, with safety, there's a lower return, so you tend to get a lower return in an income fund. It used to be called the money market fund. However, we now have the option of growth and income. Everybody's okay with what I've said so far with the safer funds? Right. You have now the growth and income funds, which are a little riskier. With these funds, you find they usually grow over time. So, as I said, the income fund in the unit trust, you buy it at $20, you sell it at $20. But with the growth and income fund, the price at which you buy it is different from the price that you sell it. Growth in this case is more likely to keep in tandem with inflation. So this is something that we want to consider having in our financial planning. But the thing is, we can also experience negative growth or a loss of your investment. It provides income in the form of dividends from the stocks or from rent from properties. Income is not guaranteed, and the amount you receive can fluctuate greatly. You may have some periods when they will tell you we did not make any money, so you get no returns this period, right? I mean, I'm using the example of NEL, for example. NEL, there was sometimes earlier clock where they tell you, oh, the returns were so great, we give you an extra payment, and you, nice. But then there were some years where the returns were so low, you ain't getting nothing, right? So it fluctuates. So these investments now, you can have mutual funds that are riskier. And these could be funds that are invested in equities, in stock market that is, in property, right? We have, I think, three funds listed on the stock market and property. We had the Praetorian Fund, which is by RBCT, which is now off the stock market. We had the Fortress Fund. We had the Fortress Fund, which is one offered by a company out of Barbados, and then we have, I think, the Endeavour Fund, right? And you have the international funds. So I'm going to go speed along a little bit, right? This unit trust ad here will show you with all of them, the income fund, the growth and income, the global fund, right? And the stock market, of course, is a riskier investment. Let me just share this with stock market. This is what it looks like in the newspaper. Stock market investing is not for quick money. A lot of people I have found tend to use it as such or want to use it as such. So let's look at First Citizens. Everybody remembers when First Citizens went on the stock market? Yes. Right. When it went on the stock market, the price was $22. And almost immediately, the price started to go up. And it went to $43. Now think about it. If you weren't sure and you're saying, should I invest in First Citizens? And every day you're looking and you're seeing the price going up and you're saying, I should have, could have, would have. And then when it reached 43, you say, you know what? This double in price, I am going to invest. So you run and you invest in First Citizens. And then the next morning you open the papers and what happened? The price started to fall. And it would have gone down to 34. And you're watching it every day and you're saying, I really shouldn't do this or no. Why I do this? Why I should have followed my mind. And no, I shouldn't have buy it. And you follow, and when you reach 34, you say, but I just lose nearly $10. You know what, I'm going and sell this. So you sell it at a loss. And then the next morning, what happens? It's going back up. So it is not meant, this is a longer term investment. It is not for short term gain. So instead of looking at it day by day and trying to make a quick buck, instead what you do is you go on at 22 and you leave it. So this is the period from 2013 to 2015. Over that 2-year period, it kind of settled around 36. That's where you would make your money now, because it's a long-term investment meant to be held for the longer term, and that's where you get your return. Okay? So real estate. Why is it considered riskier? Because people invest in real estate to either flip a property, in other words, you buy it at a price and sell it for more, or you want to get rental money from it. And the thing is, you may not always be able to get it rented for the price that you want or sold for the price that you want at the time that you want. That's where the risk comes in. Because I don't know if you realize there are a lot of housing developments that were started around 2008 when the US had their housing market crash. And they're still just standing, right? So that's the challenge with real estate, right? But having said that, I would strongly recommend still that people look at real estate as an investment. Why? It's real property. I don't know if you are aware, but the monies that we use, that we have in the banks, it don't really belong to us once it goes in the bank, right? Once it goes into the bank, it's really the bank's money. You know that every deposit that you make is not considered a deposit. It's considered a loan to the bank. That's law. Look for Foley versus Hill, 1848, English law. Any deposit into a bank is considered a loan to the bank, which is why the bank could do whatever they want. And they could give themselves very high bonuses, even when people struggling and paying all sorts of things, right? Money also, and this is one of the areas I just love to deal with, the history of money and the money and prophecy, what is going to be happening with money coming forward. when we're talking about what's going to come, not for this session, but we see what's going to come, all these, this is just really zeros and ones in a computer system. How money is created is by debt. Did you know that? Every time somebody borrows, that's how money is created. When you have real estate, it's real property. You know the saying, Lando, what is this? Lando rot. Yeah, right? So it's real. Let me hurry along though. So the ones you want to really avoid, the riskiest investments would be the corporate bonds, the venture capital, the business if you don't do proper planning, precious metals, cryptocurrencies, and pyramid schemes. According to the 2022 National Literacy Survey, 35% of the people we interviewed had been victims of financial fraud, and 19% had fallen victim to a pyramid scheme. The thing is, pyramid scheme, anything that sounds too good to be true, is probably too good to be true. Stay away from it, all right? And we must learn to diversify our investments. The Bible says, cast your bread upon waters, you shall find it after many a day. Give a portion to 7 and also to 8, for you know not what the evil shall be upon the land. And this is the last area I'm going to cover. We don't have time, I'm afraid, for estate planning today, so we'll end on investments. When you're talking about starting out, you want to begin your long-term investment plan. Now, these pictures are from Investopedia. So if you're looking, if the terms are a little different, these are from Investopedia. Because you are young and you have a lot of time to work, you always want to have a fixed amount of cash, which will be things like your emergency fund. So you always want to have some cash in your portfolio. And you have a low amount of fixed income. Again, those would be things that you always want to have fixed and equities, the balance. But you could have a higher amount of equities because this is where you could take a little more risk as a young person because you have a lot of years to work. You can, if something goes wrong, you can get it back. As you reach the prime of your working, you want to continue your long-term investment plan, but now you want to have a little more in fixed income, 35 to 40%, and a little less in the higher risk, in the riskier investments, always with 5 to 10% of cash. When you reach your pre-retirement years, this is when now is the last stage before you retire. You want to get a good balance between the riskier investments and the safer investments. So you want no more than about 35 to 40% in the riskier investments and about 55 to 60% in the safer investments. And once you reach retirement, this is where you want to preserve your assets and maximize your income. So you still want some riskier ones because remember now inflation, so we have to still keep earning, but you want to make sure the majority is in fixed income instruments. This is the same thing I just told you in a table format. You would see that your cash would remain fairly constant, a little more cash as you retire, but your fixed income increases as you complete your career, and your riskier investments would decrease. All right, so as we close, we're going to look at what are some tips in terms of your investing. Firstly, always invest from a strategy with your goals. And not only that, you want to maintain a long-term perspective, meaning that, as I showed you with first lessons, to be running to check the change every morning, right? Let it do what it has to do. And you want to be wary of any instrument with extremely high levels of profits or return. Because again, if it's too good to be true, if it sounds too good, it is too good. Don't invest in anything you don't understand. And by the way, let's go back. When I say invest in a strategy with your goals in mind, if it is a long-term goal, then you're going to look for a long-term investment. If it's a short-term goal, you look for a short-term investment. Right? Diversify. Don't put all your eggs in one basket. Your risk exposure should be consistent with where you are in your life cycle. If you're close to retirement, you don't want too much of your money overexposed in risky investments. And seek professional advice if needed. Okay? And unfortunately, folks, I think time is up. So we'll leave the insurance and the estate planning for another time.